Hey, what's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan. I'm the mind behind Make More Capital, and today I'm coming at you with a special Friday episode to go over some more phenomenal MSO earnings. So before we jump in, if you enjoyed this video or you learned something, please just leave a like on it as it really helps out my channel. And then, of course, if you want to learn how to take advantage of this generational investment opportunity, subscribe below so that you don't miss any future videos. Then there's plenty of content for you to go back, rewatch, and educate yourself with. I've tried to put all the news and facts in one place so you can watch episodes to learn about the evolution of the industry over time, identify top companies that you keep seeing pop up, and then take advantage whenever you're ready. Now, we're going to get into these phenomenal numbers in a moment, but I just wanted to show you one tweet from Todd Harrison, so thank you, Todd, for sharing this. But it's more of a personal anecdote that's very relative to what we've been hearing about SAFE and when we can expect it to pass. So, Chatterbox, I've got a pal who's a size hitter, which means he has a good amount of money to invest, and he tried to move his personal account to a top 5 money center bank. He asked if he could buy US Canna and was told no, but the bank hopes to be in a position to do so by Q4. Interesting, right? Now, are they referring to MSO's Q4 or the bank's Q4? I'm going to assume in this situation that it's the bank's Q4 because the banks aren't going to be worrying about what anyone else can do. They're worrying about what they can and can't do and when they can get into cannabis and when they can't. Now, I just want to propose that for standard companies, or like the general way to break down a fiscal year, typically is first quarter Q1, January 1st to March 31st. Second quarter is April 1st to June 30th. Third quarter is July 1st to September 30th. And the fourth quarter is October 1st to December 31st. Now, if you are an entrepreneur running your own business, you don't have to follow this. You could make your Q1 July 31st to September 31st and then your Q4 April 1st to 30 if you want, but I'm pretty sure banks follow the standard model, and that would put their Q4 in October 1st to December 31st. So despite what Boris Johnson has told us, and that April 2020 is the farthest out date that he can see that it would pass if we saw all possible delays and like that was the worst case scenario. But based on what the banks are saying to a sizable hitter with money that wants to invest in US cannabis, it almost seems like the banks are looking out for Q4. So just giving us reason to believe that we could see something sooner than April 2022 next year. Now, that might not be the case, and I could be wrong, but I just wanted to show this and let me know what you think about it, because at the same time, we know Joint State Bankers Association letter to the House in support of Safe Banking Act of 2021. This was written on April 19th, 2021, but it's written to Nancy Pelosi and Kevin McCarthy, the two leaders of the House, and it has literally every banking association in America behind it. So we know that the banks want to get in. They want Congress to pass SAFE, okay? So just using this to show that obviously the banks are working in order to allow them to change the draconian, outdated reform federal laws so that they can start investing in cannabis. And then just to add on top of that, institutional ownership of U.S. cannabis right now, this comes from Jefferies, and someone shared it on Twitter, so I just wanted to share it. But just to give context, when we look at how much of Canadian cannabis is owned by institutions, 14.6. U.S. cannabis, only 3.9. And if we look at U.S. ancillary, 33.5. Big tech, 69.9 is owned by the financial sector. Big consumer, 44.3. So there is so much potential when SAFE passes. And that is why we are waiting on SAFE. We know that with these earnings, the numbers should be going up, but because of the unique circumstances and these MSOs cannot uplist on major exchanges and banks cannot work with them without fear of federal prosecution until these federal laws are changed, which SAFE would do, we know that that is the big switch. And obviously this is not for every investor who wants to make, 7% dividends every year, but this is for the investor that sees this big opportunity in the discrepancy between the actual numbers and the fundamentals these companies are reporting versus the valuations and the discounted stock price. That is what we are waiting on. So I'm sure if you've watched this channel, you're well aware of that, but if you're new here, that is what we are looking out for. So we're going to start, though, Green Thumb Industries report second quarter 2021 financial results. And again, these make up numbers for Q2, so that is sales from April, May to June. And they knocked it out of the park. Revenue increased 14.1% sequentially and 85.4% year over year to 221.9 million. So great job, Green Thumb Industries. That is massive growth. First half 2021 revenue increased 87% to 416.3 million. So they're on pace to do about 840 million at this rate. Fourth consecutive quarter of positive GAAP net income, delivering 22.1 million or 10 cents per basic and diluted share. And that's a positive 10 cents, not negative. Also, just want to note on that, they're obviously going to keep growing, so that will be more than 840, but still that gets them closer to that 1 billion run rate. Adjusted operating EBITDA grew 11% sequentially and more than doubled year over year to 79.3 million or 35% of revenue. Sixth consecutive quarter of positive cash flow from operations, delivering 43.8 million year to date of positive free cash flow. On April 30th, Green Thumb raised 216.7 million in senior secured debt at 7%, a very one of the industry's lowest rates to date. And because cost of capital is going down, that's very positive for the industry. But at the same time, the lower interest that you can get, the better. And that will change once SAFE changes as well, or once SAFE passes. The proceeds were used to retire $105 $35.5 million in senior secured debt at 12%. The remainder will be used for general working capital and driving growth initiatives. And on June 1st, 2021, the company acquired Liberty Compassion Inc., a Massachusetts-based medical cannabis cultivator and retailer, and the acquisition adds cultivation and production capacity to the company's existing Massachusetts operations. So key development post-quarter as well as they expanded into Virginia with the acquisition of Dharma Pharmaceuticals. And they also expanded into Rhode Island by acquiring Mobley Pain Management and Wellness Delaware LLC and another Cannabis Processing, which both hold contractual interests in Summit Medical Compassion Center, including cultivation and production facility and open dispensary in Warwick. So that gets them into Rhode Island, a very small state, but one to obviously try and get more share in. And August 10th, 2021, the company opened Rise Warminster, its 62nd store nationwide. Profits of the first day of sales will be donated to National Giving Alliance, which works to improve the quality of life for homeless, low-income, and moderate-income children, women, and men. So it's good to see Greentham also always trying to give back in some form, especially as they expand into new territories. But nonetheless, it's a very strong quarter from them. We're going to go through all this in the numbers, so we're not going to go through all of this. So they are wholesaling too much like the others, and as of June 30th, 2021, Greentham's family of consumer brands were produced, distributed, and available in retail locations in 12 states: California, Colorado, Connecticut, Florida, Illinois, Maryland, Massachusetts, Nevada, New Jersey, New York, Ohio, and Pennsylvania. And consumer packaged goods gross revenue grew 13% sequentially, driven primarily by expanded scale in production and distribution of branded products. So if you wanted to look more into that, you can pause and read the information here. While their retail business development, their second quarter revenue included sales from 58 retail stores across 11 states: California, Connecticut, Florida, Illinois, Maryland, Massachusetts, Nevada, New Jersey, New York, Ohio, and Pennsylvania. And the comparable sales growth stores opened at least 12 months was 34% on a base of 42 stores, driven primarily by increased transactions. Sequential comparable sales were up 7% on a base of 51 stores, and then retail revenue increased 15% sequentially, driven by increased foot traffic in established stores and new store openings. And again, as we come back to a normal world without the pandemic to worry about, there's just going to be more foot traffic as more people are willing to go out and get social as they used to. So it's great to see those highlights, just to see where that growth is coming, both from the CPG wholesale and from retail. If we take a look at the numbers, excuse me, revenues net of discounts $221 million, cost of goods sold $98 million, so just up about $15 million. And then they increased their revenues, though, from a little over 25. So, yeah, that's great. Great to see these numbers here. For gross profit left over of 122.9, up from 110.8. So that's a growth of 12 million right there. Now, obviously, their selling general and administrative did go up as they are expanding, and that is the cost of having good teams and making sure you actually get productive work done. But they managed an operating income, of $50.8 million. Obviously, over time, the more that they can get these costs down, the more they can end up keeping from operations. But again, they're still a small company growing in the fastest growing industry in the U.S., and it's an emerging growth market, which is crazy. But nonetheless, that leaves them left over with a positive $22 million in net income and positive 10 cents a share. So that's very good to see. Profitable U.S. cannabis companies. Then if we add back the interest, taxes, depreciation, amortization, it gives them an adjusted operating EBITDA, or earnings before interest, taxes, depreciation, amortization, of positive $79.2 million. And compared to a lot of Canadian LPs that are reporting negative adjusted EBITDA, this is very positive, as it's $79.2 million positive, and it's in U.S. dollars, where LPs are typically reporting in Canadian dollars. So there's so much more value in here. So great job, Greenthumb. If you are a shareholder, you should be very proud, because these numbers are solid. And although the share price is not reacting yet, again, it's a special scenario, and SAFE will reward you if you can wait until that passes. On to Trulieve. They report record second quarter 2021 earnings and expansion into new markets. They achieved a number of firsts and records, including 14th consecutive quarter of profitability, over 500,000 customers served officially as of today, or as of this date. So that's pretty cool to think that McDonald's has millions served or billions served on their signs over the time that they've been an organization. 500,000 customers served in Florida and other states. That's pretty awesome, and that's just the beginning. Became the first medical operator to start planting in West Virginia, and positioned to enter our 7th state with the production license approval in Georgia. But as far as numbers go, achieved revenues of $215 million, a sequential increase of approximately $21 million quarter over quarter. Generated net income of $40.9 million, delivered second quarter 2021 adjusted EBITDA of $94.9 million. So that, I think, is the highest in the industry so far. But that is what makes Trulieve the most fundamentally profitable and healthiest fundamentally, but all the companies are fairly close in that range. And obviously it's a matter of, it's a race against time. So we're just going to see who ends up becoming the best. But obviously fun to watch as all of them are doing great things and executing on the ground. Attain gross profit of $144.5 million and gross profit margins of 67%. Again, that's hard to compete with. And that is why I'm happy to have my Harvest shares convert into Trulieve shares, as they've announced that plan to acquire Harvest. And I believe they voted unanimously for this. So, and that was as of, August 11th, Harvest shareholders voted and unanimously for that. So that's going to go through hopefully in the next few months. And I hope that's going to spark a bit more M&A in the sector, maybe an LP trying to get into an MSO. It's going to be interesting to watch. Commenced operations and opened their first dispensary in Massachusetts as well. So that's Trulieve, a very heavily concentrated MSO in a few single states, getting into more like Massachusetts, and then opening their 91st store in the nation, maintaining leadership in Florida with its 85th dispensary location. On top of that, though, they also received notice of intent to award a Class 1 production license in Georgia, one of two companies to receive the largest license award, and I believe that's of a 100,000 square foot cultivation, positioning the company to enter its seventh state and further solidify Southeast Hub, and Georgia's got a nice population size. Completed acquisition of Keystone Shops in Philadelphia, entering the greater Philadelphia area and bringing dispensary count in Pennsylvania to 6. Commenced operations in West Virginia as the first medical cannabis company to start planting in the state, and currently at 96 stores in the U.S. as of right now, with new store openings in Worcester, Massachusetts on August 14th coming up. But if we look at these numbers, this is why so many people like Trulieve, because fundamentally they are the healthiest in terms of numbers, keeping 67% gross profit and net income of $40.9 million, adjusted EBITDA of $94.9 million. So it's very stellar. Just showing that fundamentally this company is very solid. Total revenue 215, up from 193.8 last quarter. Gross profit of 144.5, up from 135.5, and this is again the highest gross profit after all is said and done. And they did manage to not reduce their operating expenses, but reduce the percentage that their operating expenses made up of their total revenue. So that's good to see, as it was just 57.3 last quarter, up to just 61.5 this quarter. So that is very good cost efficiency and making. When you consider their free cash flow went up by 36% quarter over quarter, that is impressive because that's money they're generating from their own operations. Profitable, and adjusted EBITDA up to 94.9, up from 90.8, just 4%. But again, that's showing that they're keeping a lot more profits afterwards than some other MSOs, at least at this point. But their net income gap, 40.9, we add back all the interest, taxes, depreciation, amortization, and this gives them the top adjusted EBITDA so far in the industry at 94.9. So again, very happy Harvest to be Trulieve shareholder with these numbers, and that's why I do want to hold those shares for the long run. But this does set Trulieve aside as a company with a lower market cap compared to Green Thumb and Cureleaf, but making $5 million less with greater profit margins and greater net income numbers. So it's great though from Trulieve. On to Columbia Care, reports second quarter 2021 results. Record quarterly revenue of $109.7 million, an increase of 232% year over year, 19% quarter over quarter. Record quarterly adjusted gross profit of $47 million, an increase of 300% year over year, 26% quarter over quarter. They reaffirmed their 2021 revenue guidance of $500 to $530 million and adjusted EBITDA guidance of $95 to $105 million, and raised $74.5 million in Q2 at a 6% convertible debt. So this is 1% better than what Green Thumb raised. So it's just going to show that cost of capital is going down in this industry, and those with money willing to lend are seeing this industry become less risky as time goes on, and especially as these fundamentals improve, reflecting the lowest price debt in the company's history, and in Q2 with balance sheet of 149 points. Let's just scroll down to the numbers. They've got a nice little snippet here. So after removing the cost of goods sold to bring in this revenue, they've got an adjusted gross profit of $47.6 million, and adjusted gross margins of 43% afterwards, with an adjusted EBITDA of positive $16.4 million. Again, though, in US dollars, so comparatively to Canadian LPs, even some of these smaller tiers are looking financially healthier. So that's great to report. Now their operational update, just going to keep this short and simple, but their selected state level highlights, their top 5 markets by combined revenue: California, Colorado, Massachusetts, Ohio, and Pennsylvania, and their top 5 markets by adjusted EBITDA, or which helped them achieve their adjusted EBITDA, would be from Colorado, Illinois, Massachusetts, Ohio, and Pennsylvania. So it seems like these would be their most profitable operations. These are the ones that bring in the most revenue, sort of thing. So obviously as a business owner or an entrepreneur, you got to balance all of this. It's not easy. That's why you need to hire good teams and whatnot. Then you can see a little bit of what they're doing in every state. Now, I'm not going to go through all this. It's just going to take time, but I'm slowly going to scroll through as they expand in Arizona, California, Colorado. So if you want, you can pause just to read here if you own Columbia Care. Florida, Illinois, Massachusetts, New Jersey. But this is also what makes them a great second tier company, because Being a second tier puts them at a much lower valuation based on the growth they could see if they execute well over the coming years. New Jersey, New York, states that are going to come online in the following years. Ohio, Pennsylvania, and Virginia. So lots to look forward to in this. Their 2021 outlook, combined revenue of $500 million to $530 million. Combined adjusted gross margins for the rest of the year, they're anticipating above 47%, so that's nice to see, with a combined adjusted EBITDA of $95 million to $105 million. That's what they're expecting for the entire year. So that is an increase from $16.4 million that they just managed. Then if we take a look, though, just wanted to show you, because as a smaller company that is focusing heavily again on expanding, they're sort of following Curaleaf's game plan of the retail growth in the right states. But again, as we can see, it's just for them to still be a small company like that, it's costing them money to set up this infrastructure, right? So the whole idea, though, is as we can see, they lost about $51 million in operating expenses. It's $10.1 million in total net loss for shareholders, but this is down from $24.1 million in last quarter. So as they continue to expand and build out this functionality that will allow them to operate efficiently, that's going to cost them less. So the whole idea is just to make sure that next quarter, this $10.1 million shrinks and then gets them closer to profitability for a smaller MSO that's really working on expanding. But seems like they've put in a lot of the capital expenditure investments and have been working on that, better that they did that last year, so that they can end up seeing the fruits of their labor and more revenues and profits because of it in the future. But again, this is why it's important for us to look out at like the end of 2022 full year or the end of 2021 full year, but even now, because we're already in August, the end of 2022 full year, as long as you can stay patient and keep that money invested, again, for safe, and then for eventual further catalysts like the actual federal legalization and all that, there is going to be lots to come, and you can play the cycles of this industry in time, I would imagine. So there's still opportunity in these medium tier cap ones. But last but not least, Cresco Labs announced the second quarter 2021 financial results. I'm very happy with this, so we're going to go through it. Obviously, company reports record revenue of $210 million and reaffirms annualized revenue run rate guidance of $1 billion by the end of 2021. So that's positive, and it seems that they expect more growth to come in the next 2 quarters that can help get them to that revenue run rate guidance of $1 billion. If we look, $210 million is an increase of 17.7 last quarter, quarter over quarter, and 122.8 year over year. That's huge. Gross profit excluding fair value markup for acquired inventory of $107 million, or 51% of revenue, an increase of $22.2 million quarter over quarter, and 233% year over year, which is huge. Net income of $2.7 million. So this is their first positive profitable quarter, an increase of $26.2 million quarter over quarter and $44 million year over year. Adjusted EBITDA of $45.5 million, an increase of 30.1% quarter over quarter, with record wholesale revenue of $108.7 million, an increase of 13.7 quarter over quarter and 97.9 year over year. And as we know, Cresco is focusing on the CBG wholesale approach. So as much as they have 33 retail dispensaries, I'll just cover that then. Record retail revenue of $101.3 million from 33 stores. That seems incredible from just 33 stores, an increase of 22.3% quarter over quarter and 157.6% year over year, which means they're retaining customers really well. But as their main approach is the wholesale revenue and sending their CPG goods products to 900 plus stores across the US, I think like this is going to be a really good breaker in Q3 and Q4 to set them apart from the others. But regardless, it's just strong. It's great to see strong growth in both of those sections, which allows them to reaffirm their annualized revenue run rate of $1 billion by the end of 2021 and gross profit margins in excess of 50% in the remaining 2 quarters of 2021. So obviously we're going to have to wait and see if they end up doing that, but they seem confident enough to provide this with an adjusted EBITDA margin run rate of at least 30% by the end of 2021. Look at their balance sheet as of June 30th, 2021. Current assets were $293.7 million, including cash and cash equivalents of $131 million. So the company's working capital of $91 million and term debt loan of $189.4. While on April 14th, they closed the acquisition of Bluma Wellness. So that gives them a greater footprint in Florida. But so if we take a look at the numbers, this is excluding the fair value adjustments, which gives them down here the 51% gross profit. So without that, they're still at 48.1, still very good. But this is what I love, because their revenue grew to $210 million, up from Q1, which they show in their report, so it's easy to see, up from $178 million. So that's an increase of more than $30 million in revenue. And then if we take a look, their cost of goods sold did increase, but not more than $20 million. So they're increasing their revenues while decreasing their cost of goods sold, leaving them with a nice gross profit of $100 million. So gross profit here, again, just $48.1 million. But they anticipate that going forward, it will be above 50%. So look at their operating expenses, though. We can see that their selling, general, and administrative has gone up. And here we can see share-based compensation of $8.8 million, up from $5.5 $1.5 million. So obviously executives are getting rewarded, but at the same time, yeah, they should get rewarded for being able to create a business that provides this sort of revenue growth and, you know, potential profitability in time. So that's just part of the game. If you can make money, you get rewarded with money. Leaving them with a positive net income of $14.8 million, which is actually down from last quarter. But after all said and done, subtracting interest and other expenses, it actually leaves them with a positive $2.6 million, which is a big improvement from last quarter, a negative $24.1 million in net income. So that's very positive. This is their first profitable quarter. And obviously going forward, the main goal for them is to make themselves more profitable while decreasing costs and SG&A, while increasing their revenue and gross profit after all is said and done. So it's great to see that. I love seeing their first profitable quarter, and I imagine for them it's only up from here. Now, if we scroll down though, how did they manage the adjusted gross profit margins of 51% when we see here 48.1%? Well, it's because what they can do is add fair value markup for acquired inventory. So let's say when they closed the acquisition of Bluma had a bunch of cannabis on the shelves that they could sell. Then basically, because they've acquired that, and that's future potential revenue, if they end up selling it, they can add this in for an adjusted gross profit of $107 million, giving that adjusted gross revenue. But they can also only do this because they do not use generally accepted accounting principles yet, because these companies can't uplist on major US exchanges. So they're using IFRS accounting practices, which allows them to use inventory as potential profit, which again, it's just something that we're going to stop seeing once they can uplist on exchanges and do convert to generally accepted accounting principles that we typically use in the West for every company that lists on every major US exchange. So just wanted to highlight that. And their cash flow statements show us that they are spending money, which is good because you want them to spend money now while they have it, while they can, in order to grow their potential revenues and profits. Because last quarter we could see that they had $258 million in cash after all was said and done. But this last quarter they spent about $43.1 million in operating activities, $29.5 million in investing activities, and $50.6 million in financing activities, leaving them with $135 million in cash, which is still a good chunk. And they also have current assets that would cover their current liabilities. But the main thing is that they do see the benefit in spending money now while it's cheap to make more money in the future. And again, just build out that infrastructure and get prepared for when this industry does unlock and becomes treated like every other US industry. So that's mostly it for Cresco Labs. And so for everyone who's asking me, Jordan, why are you invested in Cresco and not Trulieve, Green Thumb, and Curaleaf? I don't have enough money. If I had more money, if I had $500,000, I would invest $100K in the top 5 tier MSOs and just leave it and not even have to worry or think about it. But I don't, right? So I have to decide, okay, what company provides the best margin of safety, and therefore how can I get the best bang for my buck? And well, my view, concentration is what builds wealth and diversification is what preserves it once you've built it. And so that's why I'm more comfortable. It's a higher risk play, but I'm more comfortable going in on one company. But at the same time, it's because Cresco Labs at the current valuation, like Trulieve at the current valuation, provide the best margin of safety and the best potential upside, even better than Green Thumb and Curaleaf. And I'll show you what I mean by that. So if we look at Cresco Labs and Curaleaf right now, what matters is their market cap. Trulieve is valued right now at $4.2 billion, as is Cresco. Both of them are valued at $4.2 billion. And that is why I want to own Cresco Labs and Trulieve, because although Green Thumb is a great company, they're valued at $7.5 billion already, which is kind of expensive. And then Curaleaf, $8.5 billion. Again, relative to other CPG companies on major US exchanges, it's not expensive. But relative to the value you can get with Cresco and Trulieve, they are kind of expensive, especially when we consider that Green Thumb just did $222 million, but Trulieve just did $215, so $5 million less, but they're trading at a market cap of $3 billion less than Green Thumb. And then Cresco Labs as well, they just did $210, so it's $12 million less than Green Thumb, but you can buy them for $3 billion less than the price of Green Thumb. Now, Curaleaf is just sort of its own beast in its own territory. But again, for these revenues, just $100 million more to pay $4 billion more, that's a bit expensive for me. And point being, though, is I can get Cresco. I have Cresco at about $5 billion, let's just say, because my average price is $16.30 a share. So if I want my money to 5x or to go up to 500%, then Cresco has to go from $5 billion to $25 billion valuation, which is totally plausible because when Canopy reached its highs in 2018, it was valued at $25 billion and it was making $20 million in revenue. And so to summarize, and with that logic, although Curaleaf and Green Thumb right now are valued at the highest because they're making the most, that makes them expensive relative to the value you can get in Trulieve, Verano, and Cresco Labs based on the numbers we just saw them put in, because Green Thumb did $222 million, but Trulieve did $215, and Cresco Labs did $210. and they're valued at $3 billion less. So I hope that makes sense. Again, this is not advice. This is just me, a self-taught investor that used Warren Buffett and following the fundamentals and the margin of safety as my philosophy. So hopefully that makes sense to you. If it doesn't, then you can just go on to other videos, but I think that is quite simplified and help you see that when fundamentals are growing quarter over quarter by 15 to 20% and 100% year over year, yet the share prices are not moving, that's nothing to be afraid of. In fact, that's the sign of a very big opportunity behind the scenes in the works. And ultimately, look, if you want a 7% return from dividends every year, this is not your opportunity. But if you're young and you've got the cash and you want to look at this like tech, seeing this as a big generational opportunity, if you can get in cheap as a retail investor before the banks and other US investment firms can get in, it's nothing to be afraid of. It just requires patience. And it's in fact usually a bigger opportunity than most. So if you were someone that said, dang, I wish I invested in Apple or Amazon early on before tech got hot in the late 1990s, it's the exact same opportunity. It just requires, certain type of vision and clear thinking to be able to. And that is it for today's episode, folks. I want to thank you so much for tuning in, and I really hope you got some value out of it. As always, though, this is not advice, this is education. So make sure you do your own research before investing so you can come to a clear understanding yourself. But also let me know what you think about these earnings in the comments. And yes, sure, the share prices didn't go up, but again, they could pay us now or they can pay us more later. And I have a very good feeling that when SAFE passes, we're going to get paid a handsome amount if you are patient enough to wait and see that reward. So if you enjoyed this video, please leave a like on it, subscribe below if you don't want to miss any future videos, and I will catch you on Sunday for This Week in Cannabis News. Have a great day, everybody.